So, Jonathan, given everything we've discussed, what are your overall views on equities and bonds?
Sure. Let's start briefly with bonds. We've been of the view, Eugene, and our discussions at Lifespan have centered around our view that yield curves are more likely to steepen across the developed government bond markets, and they've certainly done that in France and Germany, the UK, the United States, and also certainly Japanese government bond yields. So we've seen a steepening in yield curves. That means higher yields at the longer end, particularly in the 30-year area. And we've seen shorter dated government bond yields in Europe in particular, and also in the United States decline. So the place to be in terms of global bond markets for the last 6, 9, and even 12 months has been exposure to the front end of the bond market. I still see that, big deficits, big heavy levels of government debt across the developed world will keep upward pressure on long-term government bond yields. And of course, we know that these governments are going to have to refinance their debt at higher levels, which will increase their interest burdens. And that will necessitate even more borrowing to finance the payment for the interest costs. So that's my general view. I would be very cautious still on long-term government bond yields and be much and favor the shorter end. And it's noteworthy to recall, how much global bond markets have declined in the last 3 years. Let's turn now to equities. Eugene, you and I have had this conversation quite a lot in the last, I don't know, 6 to 9 months in particular, but actually maybe longer, where I've got this kind of conundrum, or I could call it, you can call it a contradiction if you wish, where I've got this relatively cautious macro view with regard to the US economy, but at the same time being very positive, very bullish on AI, and in particular what I've called for some time the so-called Magnificent One, which of course is NVIDIA. So I'm still very enthusiastic, very excited about AI and the promise of AI and the promise of this new, very transformative new phenomenon. But at the same time, the macro backdrop in the United States is fiendishly complex. And as we've already discussed, I think the US economy is firing on one cylinder, namely the AI related spending cylinder. So I'm kind of caught there. So at the end of the day, if you take out NVIDIA as the Magnificent One, but you then take out the next top 5 or 6 companies in the United States, they are generating by far the lion's share of earnings on a quarterly basis. But at the end of the day, the United States is still exceptional, particularly when we make the observation out of the top 10 companies in the world. Pretty much every one of them is in the United States, maybe with the exception of one. So ultimately, my conundrum has been, and I've shared this conundrum with my readers, is I've had this kind of fervor about NVIDIA and AI, where I'm being cautious on the United States, because at the end of the day, Eugene, all of us in this industry, all of us who enjoy this industry, all of us who have a respect for history, can only make one observation. And that observation is a factual one. This is not an emotional one. This is purely based on fact. It is an irrefutable fact that the price to book ratio on the S&P 500 today is the highest in history and has actually just surpassed what prevailed during the tech bubble in 2000. It is also a fact that the price to sales ratio on the S&P 500 is at an all-time high, surpassing the previous high in 99, 2000. It is also an irrefutable fact that the enterprise value to sales ratio for the S&P 500 is at an all-time high. It is also an irrefutable fact that the so-called Warren Buffett indicator, which measures the total value of the US stock market versus the underlying economy, US GDP, is at an all-time high. It is also an irrefutable fact that the price earnings multiple is not at an all-time high, but is not that far away from an all-time high. So if you are faithful to your valuation measures, your metrics, you would have to, by definition, be more cautious here than being aggressively long. But, and here's the caveat, and here's the conundrum which you and I have personally discussed. I've just ranted on about the Magnificent One and NVIDIA and AI, and saying, if I showed you a chart, or our listeners right now, the projected revenue generation from data center sales, data center related revenue growth for the Blackwell GPU for NVIDIA, it is absolutely staggering. I'm thinking of actually putting it in my next report. So that's my conundrum. The bottom line is the US stock market is expensive, full stop. That's not an emotional biased perspective. That is an objectively fact-based perspective. But then we've got NVIDIA and the AI phenomenon. So that's my conundrum. But you know that because I've shared that with you.
Yeah. Yeah.
Now, yeah, then there's some other areas of the markets which are more exciting, which we can probably talk about.
Yeah, sure. So to sum that up, you're cautious on long-term fixed rate bonds, and you're cautious about equities. Sounds as though that's largely due to the fact that US equities are very expensive on a range of different valuation methodologies, and there's many of them out there. But you don't seem to have grave concerns from a macro point of view. I mean, there's problems and there's uncertainty and risk out there. You're not overly bearish. You're cautious is perhaps a better way to describe it. And I think diversification is key when we feel a little bit like this. And given that the US stock market is such a huge portion of the global index, what is it, 60 to 70%, depending on which index, because again, there's lots of global equity indexes. It's not that easy. Well, it's easy to have an enormous amount invested in the US and perhaps not realize it. If you're investing in index funds or even just global active funds, most of them will have high weightings to the US. So trying to do things to maybe give you a bit more breadth and diversify away from some of these risks, but also respecting and recognizing that, you know, some of these stocks like NVIDIA is a great example are expensive for a reason. That they're phenomenal companies, and their earnings runway are significant. So it's a tough market to be in at the moment.
I think it's a very tough market. And I think, you know, we just mentioned, you know, some of the key valuation measures. And, you know, if one is operating in a kind of relatively emotion-free, objectively based, fact-based, valuation-based decision-making process, you have to be cautious when valuations are near historic highs. I mean, the valuations are at historic highs in relative and absolute terms. So that makes you cautious. But as we've already discussed, there is the conundrum that we've got to acknowledge and recognize that we are witnessing, you know, this transformative phenomenon called artificial intelligence, and the jewel in the AI crown is the magnificent one.
Yeah.
It is NVIDIA. And I think NVIDIA has at least a runway for the next 2 years in terms of growth. And by the way, we get the NVIDIA result on the 27th,
Right.
on the 27th of August. So make sure you're up for that one.
No doubt you'll be watching and writing about it in your following.
I will be.
Absolutely.
I will be.
I look forward to that.